All right, I think the recording has started. Okay. So let me share my screen, then we start. Let's complete the illustration. Then we can move to withholding, I say withholding tax, VAT. Yesterday I was calling VAT withholding tax. I was calling withholding tax VAT. Now I'm calling VAT withholding tax. I don't understand what's happening. Okay. So you guys can see my screen, right? All right. So let's continue with withholding tax. Yeah, take this one. Okay. It did Cuba Limited. Um, I think there should be no question regarding Cuba Limited. Let me see. I'm sorry, I can see discrepancy in what we did yesterday and the solution I did personally before the class. This one, how many percent did we use? 5% of how much? Our money limited is a company. Please let's go and check. How many percentage is technical services? Consultancy technical service for limited is 5% now. Okay. Wait, 1, 2, 3. I wrote this. Imagine. Okay. So I guess that was it. So second example, Adebola Limited. Let me do it beside it. Adebola Nigeria Limited. So a little recap for those that were not in class yesterday. I want to be fast because the VAT is a bit plenty, though the calculation is small, right? So we talked about withholding tax, and I said withholding tax is not a type of tax, but an advance payment of company income tax. So how it works is that it works only on contract of supply. It does not work on our day-to-day, like over-the-counter sales and purchases. When a particular sales or purchase or transaction falls under there's a word for it. I'm coming. Let me check the word here. I think it was used in this. Falls under any sales or purchase in the ordinary course of the business, then you are not supposed to do what? You are not supposed to have withholding tax on such a thing. So let me give practical example. For example, Adebola Nigeria Limited supplied, let's say, bags of rice to me. The supplied bag of rice, and normally it's not like how can I say it? The contract of supply, I bought in, like, let's say, tons. So if I want to pay Adebola Nigeria Limited, I would pay them net of withholding tax. I would have removed what? 10%. So the rice that I got from Adebola, will not be something that I want to sell in pieces. Just like all these model that are in the market, no, they buy in wholesale bulk and they sell in pieces. For that kind of person, you're not even expected to remove withholding tax because that purchase is in their ordinary course of business. It's normal purchase. It's just like in this question that they said that they bought purchases of goods used in the ordinary course of business. That's a very different thing. Now we are talking about a contract, something that is not a routine thing. It's not what's it called? It's not something that happens all the time or over the time, right? So more or less like a one-off transaction, something like that. So the person that will not pay the money, in my own case, I'm paying Adebola for the rice that I got. So I would remove whatever percentage, whether 10%, 5%. Rice is not a good example. Let me use dividend or interest. When you buy shares in a company, you are going to receive dividend. And if you're the type that buy shares, you will notice that your dividend is net of withholding tax. They will tell you that they have removed withholding tax of 10%, right? So that's like advance payments of what company income tax. When you now calculate your company income tax, and you have information that the company has a what tax receipt, withholding tax credits of total amount, then you calculate your CIT, you calculate your TET, you add it up. You are expected to remove the withholding tax credit from that tax liability to now know the balance payable, because withholding tax is like they have paid part of their company income tax before. I hope that explanation suffice. Okay, so let's do example 2. Adebola Nigeria Limited has been trading for many years, which means it's an existing business, and they make up their account to December 31st annually. The extracts from their POL for the years ended December 2022 as adjusted for tax purpose as follows. So we have this trading profit, bank interest received. This is the gross amount. They receive gross amount. Debenture interest received. They receive gross amount. Dividend received from Adese Mowo Limited. They have shares there and they receive dividend. Dividend paid to shareholders, gross turnover. Compute the company tax liability for the relevant years, ignore capital allowance, determine the net withholding tax payable or receivable by Adebola arising from dividend paid and received. So computation of tax liability, I don't think we need to waste our time on that. All you need to do is add your bank interest, debenture interest to your trading profit and calculate your CIT on it, right? Because of course there's no expenses here, so that's just what you do. That B is what we're after. So now the question says that you should calculate what's it called, withholding tax payable from what? Dividend paid and received. Dividend paid and received. So now, assuming they did not tell you that it is dividend paid and received that you should calculate withholding tax on, you might want to consider this to interest. But the question here is that, did they remove withholding tax from this money? Because it is written here that the amount the company received is a gross amount. And gross means withholding tax have not been what? Deducted. I don't know if you understand me. As long as the word, see this one, it has the word net. Net means that it is net of withholding tax, which means the person that paid them that money have removed withholding tax before paying them the money. I hope I'm making sense. So even if you were not told, even if you were not told that if you use dividend paid and received, from the receipt of the bank interest and the debenture interest, it's kind of evident that the withholding tax was not deducted before payment of that amount. So you can like ignore them, since there is no indication that withholding tax was deducted before being paid to the company. So now we're going to be focusing on what's it called? Only dividend. So let's do 2024, 2023. Okay. So let's do dividend received first. Remember, if you receive the dividend, it means that the person that paid you dividend is the one that removed withholding tax. So that's like credit for you. Somebody have want to pay something on your behalf, right? So dividend received. Now, please pay attention to this calculation. I'll write it out so we'll not be confused. They wrote the word net. It means that this 720,000 is not 100% of the money. It is 90% of the money. Let me repeat myself. The word net means that this money is not 100%, but 90%. Withholding tax have been deducted. So if you calculate 10% straight on this money, you cannot get 10% of the original dividend amount. Rather, you are calculating 10% of 90% of the money. So before you cannot calculate withholding tax, you need to take this money back to 100%. And how do you do that? It's going to be 720,000 divided by what? 90%. I don't know if you guys understand what we are doing. So what do we have? So we have 720 divided by 0.9. 720 divided by 0.9. 800, right? So the answer to this one is what? 800,000. Now multiply by 10%. So for 2024, we have what? 80,000. That should be 80,000. Please, do you understand? So it's going to be the same amount for 2023. It's the same figure, 720, 720. So it's also going to be 80,000. I hope we are good. So now this is the one that was this is the withholding tax deducted by another company on behalf of Adebola. So withholding tax that Adebola now deducts, the one that they paid to their shareholders. Let's calculate that one too. So that's dividend paid. So this one is gross, so we don't have any issue. 3 million straight multiplied by 10%. So this is what 300,000, and this is 300,000. So now, guys, Adebola is expected to pay 300,000 withholding tax on behalf of its shareholders, while somebody has already deducted 80,000 withholding tax on behalf of Adebola. So what will be the balance that Adebola will pay to the government? That's what is it? That is going to be how much? 220,000. So 220,000 is what Adebola will pay to the government as withholding tax on behalf of its shareholders. I hope I am communicating. And that will be all for withholding tax. We can move to VAT. I'll combine the, I don't know if I should combine the Excel, maybe I should make it a different file. Samuel, your hand is up.
Good afternoon.
Yeah,
Sorry, man. That the dividend paid to shareholder is
yes.
200,000, 300,000.
Is what?
200,000. Because it's 2 million.
200,000.
Yes,
I
because it's 2
don't
million.
understand.
In that
It is,
dividend paid, question, ma. The question is said 2 million paid. 2023 is 2 million paid to dividend. A dividend paid to
oh,
shareholder. So that should be 200,000.
sorry, I did not notice. I thought it was the same amount. So
So,
this
ma.
one will be 120. Okay, thank you for that. So Blessing,
He asked the same question. Like it was supposed to be 200,000. So he asked the same
please.
question.
All right, sorry. I did
Thank
not, I just automatically assumed that it was the same thing. I did not check it at all. Okay. So any question on withholding tax? Please, guys. Yes, I'm recording the question, Ibrahim. I'm recording the question. You said the question. I'm recording the class. Okay. Blessing, you can put your hand down. Since there is no question on withholding tax, we might want to move to VAT. See this VAT, as you can see the number of pages, 22 pages. I'm not going to be reading verbatim, please. I would ensure that we touch important things, but there are some things that you'd have to go and read by yourself. For example, what is composition of kinikon, you have to go. You cannot waste time on reading things that you can read by yourself, and you don't need to explain. Do you get? So let me put VAT here. Let's also do VAT here. VAT. Let's increase the font, make it bold, so they can know that this is where VAT can start. Okay. I can rename before I forget. So unlike withholding tax, that is an advance payment. VAT is a type of tax. It's like a consumption tax. Okay. So I think that's better. Okay. I hope we can see the PDF. Hope it's not too tiny. Okay. So VAT is a consumption tax, and it is collected in a multi-stage. Every stage of production and sales of goods you pay VAT. Like withholding tax that we are talking about, contract of supply, not day-to-day activity. This one is day-to-day activity. Everybody pays VAT. You probably have even paid VAT today if you've gone out to buy in a place that VAT is being charged on their goods. So everybody pays VAT, right? And it's on every stage of production. When you buy, you pay VAT. When you sell, you deduct VAT, right? So what are the objectives? To increase government revenue, avoid cascading effects, make the tax more transparent, blah, blah, blah. Administration of VAT now. VAT shall be administered by the FIRS, which is now NRS. Please don't forget. I'm sorry, I did not think about it. This should be NRS, not FIRS. So additions from Finance Act 2023, number one. Collection of tax by a taxable person. Collection of tax. Now, a taxable person shall, upon supplying taxable goods, Mr. Ma, shall upon supplying taxable goods or services to his accredited distributor, agent, client, as the case may be, collect tax on those goods at the specified rate. Then the tax collected by the taxable person is known as output tax. This output tax is related to sales. So if you sell, you are going to collect VAT, and that VAT on sales is called the output VAT. Output VAT sales. So what I used to do is, when you sell, you give output. You are giving output is output to sales, input to purchases. So now, this tax that you've collected from your customer, from your agent, must be remitted on or before the 14th day of the following month in the currency of transaction, which means if today is what I think 21 of February, I sell anything to Adepola Nigeria Limited, and on it I charged VAT, the VAT must be remitted on or before 14th of next month. So from the 15th of February to the, let's say, 13th of March, All the schools that I've sold that has VAT will be remitted 14th of March. No, so March is mistake. Anything in February will be in what? March 14. Anything in March will be in April 14. Do you get like that? Like that? 14, 14, 14. So now tax paid by a taxable person to the supplier of goods and services purchased or supplied to him is known as input tax. I think I've already said this. Output is to sales, input is to purchases. When you purchase, your goods come to you now, is in. Purchases in, input VAT. Sales out, output VAT. Do you get? So if the output tax exceeds the input tax, it means that the VAT that you collected from your customer is higher than the VAT that your supplier, you have more than one supplier now. So you calculate all the VATs together. All the VAT that your suppliers have now collected from you is smaller than the VAT that you've collected from your customers. What will you do? You remit the excess to the board. That is, you'll be the one to pay extra VAT. But if it is the other way around, that is, if the one that you purchase for suppliers, or say purchasers is a good English, right? Suppliers, if the one that they collected from you is higher than the one you've collected from your own customers, then you are entitled to a refund from the board. Do you get? So now, definitions. Good. What are good? All form of tangible properties, whether movable or immovable, but does not include land and building, money or securities. So this is a good. Services, anything other than goods and services provided under a contract of employment and include tangible or incorporeal product or set of property over which a person has right of ownership and it derive benefit and can be transferred from one person to another, excluding land and building, money or security. Exported services now. So how do you know if you can classify a service as an exported service? Number one, it must be provided by a Nigerian resident to a non-resident. So it must be provided. I'm sorry, excuse me, please. Just a minute.
Before now, the
Sorry for that. So I was explaining how to know if a particular service is an exported service, and we said that the service must be provided by a Nigerian to a Nigerian resident to a non-resident. Then the non-resident to whom you provided the service to must be outside Nigeria when the service was consumed. It's not like Oyibo will come from their place to Nigeria. You now sold something to Oyibo, or you provided some services to him, and you're not saying it's an exported service. Oyibo is in Nigeria, or it's not exported though. The person has to be outside Nigeria. So then you have to note the following. VAT applies if a non-resident consumes the service in Nigeria, which means it is not an exported services. You have to charge VAT. It applies if a third party provide a service on behalf of non-resident to its permanent establishment in Nigeria. So let's break this down. The person truly is not in Nigeria, is a non-resident, and might not even be in Nigeria. But the thing is that the person that provided the service did it to the person's permanent establishment in Nigeria. I think, okay, you guys are skilled. I thought if it's professional now, I would have asked what permanent establishment is. It's like a building, a structure, a fixed place. It could be a shop. Do you get? Or a house. But the fact is that this permanent establishment is an immovable property and it is owned by that particular non-resident person. As long as it's owned by the person, the service rendered to that apartment makes it or should I say nullifies it as an exported service, which means the service is not exported. the service was consumed in Nigeria and you have to charge VAT. It's not an exported service. VAT does not apply if a fixed base of non-resident provides a service in Nigeria. A fixed base of non-resident provide a service in Nigeria. So what we are saying is that if the non-resident now has a fixed base, it might not be in Nigeria. But I would say it is not in Nigeria, but they provide the service in Nigeria. Should I use Meta as an example? Facebook, Instagram, all these people, they provide. I don't know if they're a perfect example, Sha, or any other service company, not in Nigeria. They have fixed base other places like an office, but then they provided service to a Nigerian company. They are not expected to deduct VAT because they are not even a Nigerian company to begin with. Their permanent establishment is not in Nigeria. Fixed base is the same thing as permanent establishment, please. VAT applies to services provided to a person in Nigeria by a non-resident company. So, if a non-resident company, I think this 2 and 4, I mean 3 and 4 seem to be a bit complicated, but let's break it down so we'll not get confused. VAT applies to services provided to one person if the person is in Nigeria and the company that provides the service is a non-resident company. That's where Facebook will come in. Now, Facebook, Instagram, owned by a single company, and the company is not even a Nigerian company. They provide service to us, just like we used to pay for advertisement. Now, they can pay VAT. Like, part of the fees that they have paid would include VAT. But for number 3, the fixed base of a non-resident provides a service in Nigeria. So, a non-resident has a fixed base, an establishment, and the service is provided in Nigeria, inside Nigeria. You're not supposed to pay VAT. They are not paying VAT on that. So even this number 4 does not mean that the person has a fixed base. Coco is that the person is not, the company is not in Nigeria. Whether the person has a fixed base or not, the cocoa is that the person is a non-Nigeria, the company is a non-Nigeria company and is providing service to a Nigeria company. I hope we are good. So now, taxable person can be a person that independently carry out economic activity, including production, trading, supplying services, exploiting tangible and intangible property for income. That's a taxable person. And a taxable supply is any transaction for the sales of goods or performance of service for consideration in money or money's worth. Goods and services shall be deemed to be supplied in Nigeria if number 1. So how do you determine if the goods I have supplied is supplied in Nigeria? The goods are physically present, imported or assembled, installed in Nigeria. The beneficial owner of the right in the goods is a taxable person in Nigeria. So it means that, like, the owner of the goods, the person that has control over the goods is a taxable person in Nigeria. For services, it is rendered by somebody physically present in Nigeria, or it is provided to and consumed by somebody in Nigeria, regardless of the service location. So this regardless of service location is telling us that even if the service was provided by someone that is not in Nigeria, it is still what in like a Nigerian service. How should you say it? Service provided in Nigeria, regardless of whether the person that is providing service is outside Nigeria. As long as the person you provided service to now is in Nigeria. Now it is connected with existing immovable property located in Nigeria, which means that the person providing the service might not be in Nigeria. The person that they are providing service to might not be in Nigeria, but the place that they are providing service to, let's say, Mr. Etim and Mr. Koyum are both outside Nigeria. But Mr. Koyum has a house in Nigeria that he wants Mr. Etim to work on. Because the house is in Nigeria and of course it's immovable, VAT applies. That's what the story is saying. So for incorporeal, we have exploitation of the rights by a person in Nigeria. That is the person that has rights to such incorporeal. Incorporeal are like all this intangible stuff, copyrights, patents, blah blah blah. So the person that has the right to it is in Nigeria, number one. Number two, the right is registered or acquired by a person in Nigeria. Number three, it is connected to an immovable or tangible asset located in Nigeria. It's almost the same thing as services. So now service rendered to Nigerian residents outside Nigeria are not liable to VAT. Let's clock that. So if you are a Nigerian resident, like Blessing now, Blessing can go to London tomorrow. Blessing is a Nigerian, she cannot deny us. But if she now goes to London tomorrow, now she got service, maybe all this water service, what they used to do in London, I don't know. I've never been there, but they shall have services there. Then she got those services. She's not expected to pay VAT now because how come? How does it relate to us? The only person who knows is Blessing. Do you get? But remote services provided to Nigerian residents are liable. Remote service. So you got somebody from abroad, as Blessing is still with us, go till London, she's still here. Then she got somebody from abroad that like did something for her, maybe a virtual assistant or blah blah blah. They provided that service to her, even though they're not in Nigeria, they are supposed to what charge her VAT together with the amount of the service and ready to the Nigeria government because it's like the profit that they earn in Nigeria. It's attributable to Nigeria. Now, service provided to person while in Nigeria are liable to VAT in Nigeria. So when we say provided to persons, whether you are a Nigerian resident or you are not a Nigerian resident, you took that service in Nigeria, you pay VAT. Service performed in Nigeria. Sorry, please.
Hello, is it just me? I can't hear anything. Can anyone hear me?
I'm sorry. So I had to receive the call because stop that. Because um the call is quite important. So what was I discussing? Okay, top it now. I think we already spoke about the fact that services provided to person in Nigeria is liable to VAT. Services performed in Nigeria to persons in Nigeria is liable to VAT, irrespective of the resident status of the service provider. That is whether the person is resident or not resident. So if somebody is in Nigeria, you provide service to the person in Nigeria, whether the person is not resident you, or be resident you, at least the service provider, you pay VAT. So now what are VAT exempt? We have VAT exempt. That is goods and services that you are not supposed to pay VAT on. VAT exempt. Number one, we have goods, medical or pharmaceutical products. So if you go to the pharmacy and this is a like medical product and they wrote VAT for you, you are a tax consultant. You cannot be doing item and they be cheating you on tax and you not talk. You tell them that this thing is a VAT exempt item. Why did you charge me VAT? You speak up. Basic food items. All these our gari that you buy in the market. When we say basic food item, you know we are talking about gari, rice, all those blah blah blah. If they have packaged the item, you go and buy item 7. Item 7 is not basic food item. You enter what's it called? Chicken Republic. Is that still Chicken Republic? I don't even know. You shall enter all those big restaurants and go and eat and you're saying it's not basic food. Yeah. Don't they will carry you with a fight. They will carry you because it's not basic food item. You know, when you're eating jollof rice and chicken and salad, and not saying it's basic, that one is not basic. It has been processed into something good. So that one will surely be liable to what? VAT. Books and educational material. So if you go to a library to buy book or a bookshop to get book, they are not supposed to be charged VAT because it's exempt. Baby products, exempt. Plant and machinery imported for use in export processing zone or free trade zone, provided that the production of that company is 100% for export. Otherwise, the part that they did not export is going to be charged to VAT. So they brought in machinery to what? To process goods that they to export outside Nigeria. That thing will be VAT exempt. That machinery or plant will be VAT exempt. But if they're not selling everything as export, the part that they are selling in Nigeria will be liable to VAT. Plant and machinery for what? Utilization of gas in downstream petroleum operation exempt. This is plenty, eh? Let's keep. You can't read the name by yourself. Please, you have to like know at least some part of this one. I know you cannot cram everything, but at least cram half. The simple ones, cram it. There are short simple ones that you can cram. Then services that are exempted from VAT. We have medical services, which means health care for both human and animal, rendered by a qualified professional, but it excludes cosmetology, spa, gymnasium, and seminar service. If you go to the spa and you are saying it's VAT exempt, they will carry you. It's not VAT exempt because somebody that have money to go and do spa and cosmetology, it does not need the exempt VAT. The person has money, you. So we're talking about basic medical services, like when something is wrong, you go to the hospital. You're not supposed to pay VAT. Services rendered by microfinance bank, People's Bank, and mortgage institutions. Please note that it's not all the bank you. It's not all. No, we pay VAT now. When you check your bank statement, you see now you have electronic money levy, money transfer money levy, ETML. Though that's not VAT, but there are some VAT that they used to remove on money if you analyze financial statements. So claims and performance by educational institution as part of learning, no VAT. Sometimes these schools used to do their English theory card, the theory card that they will go to the theater and they will show their play and people will pay to enter. That payment, no, since they're using to teach those kids, no VAT on it. All expected service, no VAT. Shared passenger transport available for public use, no VAT. Let's read the remaining by ourselves. Tuition to nursery, primary, secondary school, no VAT. Zero rated supplies and services. Now, these ones, they are not VAT exempt. You are going to like charge VAT on them, but the percentage that you will charge is 0%. Please, the difference between exempt and zero rated is that exempt, they are totally exempt. You are not charging anything on them. But zero rated, it means that you are charging something, but the rate is zero. I know it sounds absurd, but that's what it is. It is what it is. Then there's another difference too. For tax exempt, no input, no output VAT. No input, no output VAT, because of course they are exempt. But for zero rated, it's input and output. It has both. You cannot be that 0, but at least you are recognizing the fact that you want to pay VAT, but your percentage is 0. So VAT reverse charge. VAT reverse charge. A mechanism where the buyer is required to account for VAT instead of the supplier. It applies to supplies made by non-resident suppliers who are not registered for VAT in Nigeria. The buyer is responsible for accounting for VAT, must self-assess the VAT payable and remit it to FIRS. I think this is very simple, right? So the person that is supplying is like the seller is the one that is supposed to remove VAT from your money or add VAT to your money. If your money is 4,500, VAT is, let's say, 500, so you'll be paying 5,000. The 500 will be remitted to FIRS latest 14th of the following month, right? And the person will now go and file and remit. But now, if the supplier, then we said that remote services, whether the person is in Nigeria or not, you provide a service to a Nigerian resident or somebody that is in Nigeria, you have to pay VAT. But this person is a non-resident company. It's not like in Nigeria. If you register a company within, I think, a month, 30 days, you must have registered the company for VAT and TIN. You have to like register the company for tax purposes within a month. But this company is not even a Nigerian company, so there's no how the person has TIN or other things necessary to remit and file VAT. In that instance, you that you bought from the person are now responsible to charge yourself VAT and pay to the government. That's what this one is saying. So we have the benefits. It simplifies VAT compliance by non-residents, reduce administrative burden, ensures that VAT revenue is collected on supplies made by non-resident supplier. So what are the challenges? It is complex to implement and administer, can place burden on recipients, and can lead to error in VAT accounting and remittance. So basic tax point now. Basic tax point. This is the date when VAT becomes due and payable. It marks the point at which the supplier must account for VAT. Just like we have all this, when do we recognize revenue? When do we recognize expenditure? When do you say revenue has been earned? And when do you say expenditure has been incurred? When do we say VAT has been what? Should I say earned or being incurred? I don't even know how to put the word. But when do you recognize that VAT is like VAT as a code, something like that? So BTP is the earlier of the dates of issuance of a tax invoice or the dates of the payment for the supply. So you have supplied a particular goods that you tax charged on. You tax VAT on, sorry. The person might have paid immediately, which in that case, BTP is going to be the date of payment. Of course, Since you have collected the money, you have to know that, oh, you have to account for VAT. But in the case that the person did not pay immediately, what you do is to give the person an invoice. And in the invoice, you will have indicated that VAT is what? Is the particular amount. Moment the person has collected the invoice, the person has like accepted the liability to pay the VAT, and the VAT is recognized at that particular moment. If no tax invoice is issued and no payment is made, that is, you not do any of the two. BTP is the date when the supply is made. Okay, that's like for people that don't used to issue invoice. You sold on credit, but you don't issue any invoice, and the person has not paid. So, which means that the date that is you made the supply, VAT is due. VAT, BTP determines when VAT must be accounted for and remitted to the tax authority. It triggers the issuance of a VAT and tax invoice. So now let us take example. Issuance of invoice before payment. That is another example. A supplier issued tax invoice on January 15. Then the payment was made February 1. BTP is January 15. Remember, it's earlier of the date that the invoice went out or the date when the payment came in. So in this case, the invoice went out first before payment came in, which means date of invoice is when VAT is due. Payment made before issuance of an invoice. If the supplier received payment on January 15 and the tax invoice was issued on February 1, then BTP is January 15 when the payment was received. No invoice, no payment. BTP is when what? The supply was made. I think we are good. Actual tax point now, ATP. This is the date when VAT is actually paid or becomes due. When VAT is actually paid or becomes due, and might be different from BTP. That is, it might be different and it may be the same. That's what they are saying. So now, ATP is typically the date when payment is made for the supply. If payment is not made, ATP is the date due for payment, as stated in the tax invoice or contract. So now remember that BTP is based on credit supply. So it's either when you pay your money or when you are supposed to pay your money, or when you collected the supply. But for ATP, actually, when the payment schedule is made. Now, if the payment is not now made, then ATP is what the due date for payment as stated in the tax invoice. That is, we're expecting the date we are expecting payment. Now, let's take example. Number one, payment made on due date. If the supplier issue a tax invoice on January 15 with a due date of February and the recipient pays on February 14, ATP is February 14. You know that assuming is BTP, in this illustration, BTP will be January 15 because that's when the tax invoice went out. That's on the part of BTP. But for ATP, it's when you are expected to pay the money. When you are actually expected to what? To pay your money. Now, payments made after due date. In this instance, you're supposed to pay your money on what? February 14. Oh, wow, so only February 14, you paid in March 1. Then actual tax point is what? March 1. I hope we are good, Sha. So effective February 1, 2020, standard VAT rate applicable on all vatable goods and services 7.5. So like withholding tax, VAT rate is what? Is flat. It does not change. 7.5% is what is the VAT rate. 7.5%. Registration for VAT. So all taxable person must register VAT immediately upon the commencement of business. So every contractor, blah, 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 must produce evidence of VAT registration before they can obtain a contract with the government. So you want to do business with the government, whether a ministry or be any statutory body, you cannot be somebody that evade tax and you now want to come and do contract for the government. How? So the money that you did not contribute to, you want them to spend it for you. It's not possible. So a non-resident that makes supply to Nigeria shall register for tax with the relevant authority and what obtain TIN. It shall include tax in the invoice to us for all taxable goods in Nigeria. Okay. I think these are things that we've discussed before. Don't let us waste time. The registration for VAT. A taxable person who permanently ceases business is expected to notify the service that he ceased business within 90 days for the purpose of the registration. It means that just as you've registered for VAT purposes when you started business, they are supposed to deregister you when you cease operation, which means you are no longer in operation. You have to do what? You have to speak up and say, oh, I am no longer in what? Operation. And they will just know that this person is now inactive. And if they did not receive any VAT from you, they know the reason why you did not receive any VAT from you, because you have ceased business. Okay. But if after you have ceased business and you have even notified them that you have ceased business, you now made taxable supply, you have to do what? You have to file VAT on that taxable supply. It's going to be seen as if the taxable supply was made on the date that you ceased business. So if you did not now file money for that thing that you did after your cessation, penalty will like, you have to pay penalty when the tax authority find out that you actually made supply after season and you did not file VAT on that supply. So it means that penalty will apply. Computation of tax liability. Now, in computing VAT liability, you first determine the output VAT by doing what? Multiplying 7.5% on the total sales net of allowable sales adjustment. These allowable sales adjustments are like expenses that, is necessary for you to sell goods. Allowable expenses that you can deduct before you can say this is your net sales proceeds. So when you now get your net sales proceeds, multiply by 7.5%. That's your output. But remember, sales is output goods, output VAT. Sales is out, that is output VAT. Purchases is input VAT. Now, thereafter, that is after you have known your output VAT, then you calculate your purchases, remove the allowable adjustment, and do your 7.5 over the net. That is after you have removed allowable adjustment. VAT liability is now what? Output minus input VAT. We expect that your output VAT will be higher. That means you will remit more. But if reverse is the case, you are entitled to a refund. However, the VAT liability for the current period can further be adjustment if they are VAT reverse charge already deducted by a third party during the same period. A further adjustment may also be made if there is a VAT credit in the previous period. We said that if there is a VAT credit, that is your input VAT is more than your output VAT, you are entitled to a refund. Me and you know that in Nigeria, you cannot get a refund. I hope nobody will come and carry me as I'm saying this thing. But nobody will give you money in Nigeria. So what they will do now is that in your next period, like in your next month that you want to pay for VAT, you can now use that money to offset. Okay, I'm supposed to pay 4 million for VAT, but the tax authority was owing me 1 million last month. So you remove that 1 million before you pay the money. That's what you do. So then the net VAT after the above adjustment will result in either VAT credit or VAT payable. So after you have removed your VAT input, VAT output, if you have any VAT credit before you have removed it, it will lead to either you have more VAT to pay or the tax authority is now owing you money. If you have more VAT to pay, that's VAT payable. If the tax authority is now owing you money, that's VAT credit, right? So now sometimes you have opening and closing inventory when you want to calculate your VAT. I noticed that in the past question, this VAT comes out every diet. Every diet. It's like CGT for the advanced tax people. I don't think you guys are doing CGT, but advanced tax people are doing it and it comes out every diet. So CGT in advanced tax is VAT in this your place. So please, if you have any question, don't hesitate to ask me. Ask questions, please. So now we're talking about opening and closing inventory. If VAT liability includes inventory, there will be need for further adjustment of input VAT. Remember, input VAT is on what? Purchases. Input VAT is purchases. Output VAT is sales. Please don't forget that. Don't mix it up. You are mixing it up. Law. I don't even know how to say it. But everything has spoiled. You have go. So to do this, how do you adjust for inventory? Purchases for the period is adjusted by adding the cost of opening inventory. That is, you add opening inventory with purchases. See, opening inventory add purchases. Then you remove your closing inventory. So it's like you want to calculate cost of goods available for sale. You know how to do that now in your normal final account. Open inventory, add purchases, less closing inventory. What you now got, you're not going to remove all the expenses that are allowable. Like the allowable expenses are expenses that is compulsory for you to make that purchases. For example, carriage, right? You remove those expenses. The remaining money that you now have, you now multiply by 7.5%. I hope you understand it. As I'm saying that thing, you ought to be writing the format like that in your book. So it is important to note that inventory are measured at lower of cost and net realizable value. Cost of inventory are comprised of cost of purchase, cost of conversion, other costs incurred in bringing the inventory to their present location and condition. I think you guys should have done IES too, so I don't think this should be strange. But let me give you an hint. If they want to make a VAT question very difficult for you, they can put in element of IS2. So instead of giving you the direct cost of the purchase, they will give you all the components that form the cost of the purchase. It depends on your own understanding of IS2 before you can know the true cost of the goods or the true purchase value of the goods. And if you don't understand IS2, you will not be able to get the purchase value and you're not be able to get the input VAT. So because of this particular paragraph, I will implore you to understand IS2 very well, as it might affect your VAT preparation. Obligation for record keeping, for record and account keeping, that is valid VAT invoice and preparation of VAT account. Now, someone that registered for VAT, that is a taxable person that have registered for VAT purpose, is obligated to keep record and book of transaction relating to the taxable goods and services in order to determine the correct amount of tax due. A taxable person that fails to register for what? For FIRS within the specified timeline shall be liable to pay penalty of 50,000 in the first month in which failure occur, 25,000 in subsequent months in which failure occur. Please, ladies and gentlemen, this penalty is very important. You have to know all the penalty. Maybe you have a particular place that you write a table of each penalty. You read it every day so that it will stick to your head. For this penalty now, is for somebody that fails to register for what? For VAT purpose. So you know you're supposed to be deducting VAT. You don't even bother registering, not to talk of deducting. So if you fail to register, you are going to be paying what? No, if you not register, you'll be unable to file. You'll be unable to file for what? VAT. Then LRP will apply. Late returns payment will apply. That payment is now what for example, now I'm supposed to pay. This is February, right? Ahead. Today is February 21. The VAT for last month, January, I ought to have paid it latest of 14 of this month. 14 has passed now. I did not file. Why did I not file? Because I've not even registered for VAT purpose. From this February now, 50 moment till 12 o'clock on the 15th OTLU, I have incurred 50,000 naira penalty. If February completes, March 14 comes, I did not pay the money. I did not file. I did not register for VAT, and I did not file for VAT. Another 25,000. That's what 75,000. We move to April. I did not do the necessary thing. Add 25,000. That's how much? 100,000. Next month I did not do. Add 25,000. That's until you pay, until you register for VAT and you pay your penalty and everything, that they will stop counting the penalty for you. That's how it works. Even in real life, I'm telling you. That's how it works. So a taxable person registered for VAT is obligated to issue VAT invoice as well as maintain VAT account. This VAT invoice is just our normal purchase invoice, but on the invoice you write it there, VAT. As you're writing the cost of the goods, you include VAT and you add it up together. So that will like stand for VAT invoice. So if a person fails to issue tax invoice, or you issue an invoice that is not valid, you are guilty and you are liable to what? 50% of the cost of the goods for which the invoice was not issued. So that the invoice is like the evidence that the person has owed you what? Any VAT, so your cost of VAT, at least you know that you told the person that you are liable to VAT. And if you did not tell the person, or if you claim that you told the person, what is your evidence? That's the VAT invoice. And if you refuse to do that, your penalty is just 50% of the cost of goods. If the good is 3 million, you are paying 1.5 as what penalty. Also, if you fail to keep proper records of your business transactions so that you can know the correct amount of VAT to pay to the government, penalty is 2,000 naira for every month in which the failure continues. 2,000 naira okpo, abi? But then we should all be tax compliant, right? So that's it. Requirement for filing tax returns for, how am I saying filing? For filing tax, VAT returns and remittance of VAT liability. So a taxable person, I think we already spoke about who a taxable person was when we were doing definitions. Do I have message? Okay. Okay. So, okay, where was I? Where was I? A taxable person shall render returns of the taxable goods and services purchased or supplied by him during the preceding month to FIRS on or before 21st day of the following month, of the month following the month of transaction. Ladies and gentlemen, please listen to me. We have filing of VAT and we have what? Rendering of VAT returns. The two are different things. Filing is before 14th of the month. Payment of the returns is before 21st of the month. Filing, I think is here. Based on finance 2023, this one is another thing. Don't let us go here now. Let me go back to where we saw 14th. God, I hope I can see it. So we can distinguish. Between, I don't want us to be confused. Because me, God, don't confuse me, but though I know 21. Because 21 is usually our target at work. But I definitely saw 14. I not see it again. Okay. Now we are talking about filing VAT returns. 7.5%. Kó tó bo bíbá yìí jàre. Okay. Where was I? Okay, so rendering of returns. The difference between filing and rendering of returns. File is you submit your necessary files that shows your tax liability. Right? The file shows your tax liability. That's filing. It's like you submit your tax computation. Rendering of return is payment of the money. When you actually pay the money that you have calculated as your tax now. So that's what that is rendering of returns. Okay. So rendering of return must be on or before 21st day of the month following the month of transaction. Somebody should remind me on Tuesday. I want to make more clarification on. I know 21st is valid because even at work for our VAT, the VAT that we use to remit for our clients, our target is that it must not pass 21st. Do you get? For this month now, we did all our VAT last week. Everything has been completed last week. So for that 14th, I definitely saw 14th. I don't know why it's confusing me now. I have to make inquiry and ask somebody the difference between the 14th and I know there's another 14th here. That's for third party. But that one that we saw before, I wish I could see it again and tell the difference. But please put it in mind that 21st is for what? Rendering of returns. Now, based on this Finance 2023, the service may appoint any person to withhold or collect the tax, and the appointed person shall, on or before 14th day of the following month, remit the tax withheld to the what? So this one is that you are not paying to the FIRS direct. Somebody is collecting the tax for FIRS. So the person that collected it must pay the money to FIRS before 14th of the following month. This is like a different scenario entirely. A third party has been included between you and FIRS. Okay. So limitation of input VAT. Input VAT is on what? Purchases, don't forget. Input VAT is on purchases. The input tax allowed deductions from output VAT is limited to the tax on goods purchased or imported for resale that form stock in trade used for direct production of any new product on which output tax is charged. Please let's explain because it's very important. We have input VAT, VAT on purchases, output VAT, VAT on sales. Now, the purchases that you calculate input tax on are purchases that you want to resell the goods. You buy, normally you sell, should I say bag? You sell bags. Now, the bag that you bought for resale, you want to use it as your stock inventory so that you can sell them. You can calculate input VAT on the bag. But bag that you are not reselling, you want to use the bag as, let's say, end of the year gift for your customer. You're not expected to calculate input VAT on such thing. And you say you now want to come and be, you want to net that input VAT with your output VAT. No, it is only the purchase of goods on which you are planning to charge output VAT on. That is, just as you have purchased it, you are planning to sell it out back. You are selling it out again. Those are the purchases that you are expected to charge input VAT on. Please, if I'm confusing you, just raise up your hand or type in the chat box. I beg you. Because, like I said, I can see VAT in all your diets. Every diet has a VAT question. So, you don't want to, it's like a cheat code for you. Something that you're very sure will come out and you have to just know it to the best of your ability. Do you get? But I'm not saying other topics are not important. So I'm just saying that VAT is very simple now. If you are sure VAT will come out, why not target it as one of the things that you will do? Okay. So I think I've explained that one like that. The purchases that you can calculate VAT, input VAT on. So input VAT on overhead, administrative expenses that you can make as an expenses in profit or loss, that is in your P&L, or you can capitalize along with what the cost of a particular asset is not allowed as what deduction from output tax. Please let me say it again. If you buy an asset, they might have calculated tax on your assets, but we are saying that such tax you cannot come and offset it with your output tax. So you want to capitalize it with the cost of what? The cost of your assets. If it's tax on things that does not correspond with your sales, for example, you bought paper, stapler, pin, toner for your printer. Those things are administrative expenses. Don't come and offset the tax on those things with your what? Output tax, because you are not reselling them now. They are not for sale. They are for the business. So the business will expend it in their profit or loss. Please, I hope we are good. I don't like it when the class is very silent, as if you guys are not listening to me. I hope we are sure, dear.
Yes, I see it. I see it.
All right, thank you. So now that's it for those ones. Remission of VAT shall be accompanied with a schedule showing the name and address of the contractor, invoice number, gross amount, amount of tax, and amount of return. This one is like this schedule, the VAT schedule. Like if you want to pay your VAT today, payment of VAT is done on the Tax Pro Max portal. So you have to like attach a schedule. It's in like Excel format. You attach your schedule, then you pay your money. That's what they're just telling you here. That schedule will tell them the amount of goods that you bought or sold, and the amount of tax They will use that one to compare what you pay versus what you're supposed to pay. Self-account provision. It's this self-account provision imposed a duty to withhold and remit VAT on a taxable person to whom a supply is made in Nigeria, where the supplier is a person exempt from charging VAT or fail to charge VAT, or the person is a foreign company without a fixed base, whether or not VAT is included in the invoice. Emma Tonline. Don't let them to come and cash me on this thing, Sha. So what this one is saying is that you bought something from a supplier. You purchased goods. Now the person did not charge you VAT, and you know that these goods are vatable supplies. You yourself, you charge yourself VAT and you remit it to the tax authority as a good Nigerian that you have. So that's what self-account is for. So if the person is your supplier is not a Nigerian supplier, and the person is not in Nigeria, probably does not even have a TIN that they will use to charge you VAT, then that is even understandable, right? You charge yourself VAT and you pay to FIRS, right? Then what else? They say it's foreign clinical, they fail to charge VAT, or the person that is selling to you is exempt from charging VAT. You charge yourself VAT and you pay by yourself. So now, in this case, your VAT can be, maybe you're not paying directly to FIRS. FIRS can appoint somebody to collect it on their behalf, and the person will have to pay before the 21st day of the following month, in that case. So company engaged in upstream petroleum operation will continue to have obligation to withhold VAT, even when they have not commenced commercial operation or they have not reached 25 million turnover. This 25 million is for old rule. That is, they are still a small company. But as long as they are signing upstream petroleum operation, they have to withhold VAT. They have to charge VAT. A company having obligation to withhold tax shall maintain an account referred to as VAT withheld account in a book or ledger. You separate it from your VAT account. Ensure that it withhold VAT from suppliers are recorded on the credit side of that. Also remitted to the water service, that is the money I have paid to FIRS, are recorded on the debit side of the account. Ensure the statement of VAT account is made available for audit from time to time. There's something called tax audit. That is, tax authority can come to your company and say that, show us your book of account. Have you been paying the correct amount? If they now check your book and they see that you have been doing bad remission, at least your tax is 3 million, you pay 1 million to tax authority. Is that day that you pay your remaining 2 million plus penalty? That's why I used to tell companies that I understand that tax can be inconvenient, but if you do mago today, you might end up paying double. Like anytime the tax authority arches you, because penalty will end up applying. Just pay their money and let them go. Pay it. It's better than you adding penalty to the money in the future. So that's it. So VAT on imported goods and services. VAT will be charged on non-exempted imported goods. Remember that imported machines and plants or goods used for production of 100% export is what is exempted. We read it together. So now, if you now import goods in Nigeria, at least that good is a non-exempted, like it's not part of the ones that they exempt from VAT. It is based on the government assessment via Nigerian custom, which means that for these imported goods, these people, there are 4 points of VAT payment for imported goods. They are going to be paying VAT in any of these points: Nigerian Customs Service, Port Authority, shipping company or airline, clearing or forwarding agent. Which means that the goods that you are bringing into Nigeria will come into Nigeria through one of these 4 places, and it is through these places that you pay your VAT. The VAT assessment payable through the Nigerian Customs Service is calculated via summation of the following. They will sum up the following: the cost, insurance, and freight of the goods imported, import duty, surcharge, any other charge collectible by them. Total sum above is multiplied by 7.5, then you have to pay your VAT at the Nigerian Customs Service pay. VAT on imported services. VAT is payable on service rendered from outside Nigeria if such services is rendered to a Nigerian customer?
15 minutes.
Yes. Okay. So VAT on export. All exported goods and services are exempted from VAT. It is in line with the concept of destination principle, which allows for VAT to be retained by the company where the tax product is being sold or consumed. So it means that if you are exporting your goods, it is like exempted from VAT because it is a country in which people are using that goods that will collect the VAT from you. Treatment of input VAT under exempt and zero rated VAT. Now, input VAT is VAT on purchases. If what you are selling is a VAT exempt item, you are not supposed to what? How can I say it? Let us read. VAT exempt item refers to supplies that are not subject to VAT, that is, are exempted, totally exempted. Input VAT on this exempt supply is not recoverable, which means that if you have paid VAT to buy them, you paid VAT to buy this stuff, but they are VAT exempt here, right? You cannot recover your money. It's gone. Given the fact that exempt supply are not subject to VAT, input VAT incurred on these supplies are not recovered. Example, where a hospital provide medical service that are exempt for VAT, the hospital cannot recover input VAT incurred on medical equipment and supplies. Input VAT on exempt supplies is treated as a cost. I hope you guys got that. I think it's explanatory enough. Zero rated item. They refer to supply that are subject to VAT at a rate of 0%. Input VAT on zero rated item is recoverable because zero rated supplies are subject to VAT. Input VAT incurred on these supplies can be recovered even though the actual VAT is what? 0%. It means that, remember that we said that if output is more than input, you pay to the government. If input is more than output, what do? You request for a refund. Even though in Nigeria, nígbà tó bá queue tó bá ti sún ẹ, you live there. Refund required. Though I don't know now, maybe Nigeria have changed and I'm not aware. So the input VAT on zero rated can be recovered. It means that your input VAT will be more than your output VAT. Input VAT will be more than your output VAT, and you can request for your refund from the tax authority. Okay, sorry for that distraction. Example, where a company exports goods that are zero rated for VAT purpose, the company can recover input VAT or incurred on the goods, even though the output VAT is 0%. So input VAT credit. Now let's talk about VAT services rendered by financial institution and their VAT exempt income. Part of the VAT exempt, we talked about microfinance bank, People's Bank, and one other clinical institution. I was saying it there that mortgage bank, People's Bank and microfinance bank, they are different from normal banks now. You all know they are different. So now that is where we talk about the difference. Given the fact that services rendered by microfinance bank, People's Bank, and mortgage institution are specifically VAT exempt, we already talked about that. Services provided by other financial institutions are liable to VAT. Clock that. Financial institution now refers to bank, individual, body, association, group of people, whether corporate or incorporate, licensed under the BOFIA is Bank and Other Financial Institution Act, and other related acts that carry out business of a discount house, finance company, money, blah, 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 and such other businesses as the Central Bank of Nigeria, Nigeria Deposit Insurance, pension, or other regulatory body from time to time designates. So, from this place to this place is definition of financial institution. What's it that? Services rendered by financial institutions that are liable to VAT. Commissions, fees, other charges for services rendered by financial institutions to their customers are liable to VAT. Clock that now. Commissions that they charge on their service, fees that they collect from you for doing something for you, or other charges that they may have collected for the stuff that they did for you is liable to VAT. It should be noted that loan, advances granted to customers, interest chargeable on such transaction are not liable to VAT. However, additional services like documentation, perfection of loan, overdraft agreements are subject to VAT. I know there's a thin line, but you just have to understand that thin line so that you not fall victim. Insurance company, brokers, agents, loss adjusters, blah, blah, blah. In the insurance industry, including the staff, fee and commission for services to insurance company, such as income, is liable to VAT. Premium received on policies is not VATable. So, services rendered that are VATable. In consideration of services by financial institution, it is apposite to differentiate between activities that constitute return on investment and consumption of services rendered by financial institution. Now, charges arise from services by financial institution that attract VAT. Please let me try to simplify this thing. As I'm reading this, it's giving me a headache. What we are trying to say here is that there are two different things. Where you have return on investment. No, for return on investment, you are talking about risk and return. Higher the risk, higher the return, lower the risk, lower the return, something like that. And there's also what consumption of services, that is the money that you pay for the service that these people have rendered for you. Charges that arise from services that they render to you as their customer is VATable. It attracts VAT. So they receive commission for forex trading, VATable. Commission for what? Sales of your bank draft or your check for you, VATable. You pay your broker's commission or your underwriter, VATable. Because they help you to sell your assets, they collect commission, VATable. Account maintenance fee, they help you to maintain your account, huge money, VATable. Other legal stuff, VATable. So now, it's still plenty. You can read the remaining. Non-VATable. These are the ones that relate to return on investment, because this thing, it involves risk. They might get their money back. They might not get their money back. They might get their money, they might not get it. It's like 50-50 something. So it's not VATable. Example, interest on loan and advances, not VATable. People can, if the person on the way with their loan, there's an element of risk. Interest on savings accounts, interest on back deposits, interest on interbank placement, premium on insurance policy, dividend, profit or gains on disposal of security. Those ones are not VATable. So financial institutions are also what's expected to register for VAT and obtain your TIN. And they are expected to remit their VAT within 21 days from the month of what? In the month following the month of transaction. Okay. Treatment of input VAT. Input VAT is on what? Purchases. Input VAT is treated in line with input VAT. Okay, VAT paid on capital item, e.g. assets, is to be capitalized with the cost of the asset. And you're not supposed to be what? You're not supposed to add it to your input VAT, normal. You add it to the cost of the assets. VAT, we have already discussed this before, say, VAT paid on overhead, service, administration, clinical, expenses in your profit or loss. It's not supposed to be added to your input VAT. In a case where financial institution pay VAT on supplies, on goods supplies to customer, the input VAT can be what? Offset against output VAT on the same what supply. VAT recovery. Any tax, penalty, or interest that remain unpaid after the period specified for payment may be recovered by the FIRS through what? Tax appeal tribunal. So if the FIRS catch you and say, oh, there's a tax that you ought to have paid, but you did not pay, come and pay it. They carry it to a tax appeal tribunal. You can also like decide to appeal in the court of appeal and say, okay, no, I don't agree. I'm not supposed to pay this amount of money, blah, blah, blah. Okay, VAT compliance threshold. So small company, only taxable person with what 25 million and above, that is, I don't small company bracket, it's not small company. If you have reached 25 million and above, you are not a small company anymore. It's that medium or large company. There are those that are required to collect and remit parts to the FIRS. So if you are a small company, you are not required to do what? To take part unless you want to. And if you want to, you have to inform the tax authority first. So now, the taxpayer, okay, that's before this act, Finance Act 2019. So you have been, you are not a small company before the Finance Act 2019. You're not a small company. This thing is confusing. You are like a large company, but after the Finance Act, your turnover now went below 25 million. Still collect VAT and remit. That's what that one place is saying. So the next paragraph, because we don't have time, we are still in page 13. And we have not even reached calculation yet, although we'll soon reach calculation. We are getting to the end of the written aspects. And I want us to finish before 7 because I have to prepare to break my fast. So now, like I said, if you are a small company, this is what this paragraph is talking about. This one that I want to highlight. You are a small company and you feel like, oh, I can help FIS to collect VAT too, and I will give them their money. You just need to inform them. You notify them that, oh, FIS, I want to help you to collect VAT too, and I'm paying it to you. It's up to, it's voluntary, it's not compulsory. So now you expect that in this year, we are still in February, you are very sure that before this year ends, you are going to reach 25 million above. You know that now with the new tax act, it's supposed to be 100 million, and you are sure that you are going to get there. You can start charging VAT from now on. That's what this paragraph is saying. So, what other things are we talking about? I think the remaining things that are here, I think we have discussed before. Type of VAT. We have 3 different types of VAT. I would talk about their type. We are skipping advantage and disadvantage. You guys, you can read that on your own. Then we'll move to what tax invoice. So we have 3 types of VAT. Number 1 is gross product. Gross product. This is a method of computing VAT that is based on the gross value of goods and services produced or sold without deducting input VAT. So in this type of VAT, businesses are not allowed to deduct input VAT from their VAT liability. A single VAT rate is applied to the gross value of goods and services. So, which means you only calculate output VAT and you pay. You are not removing the amount that you have paid before as input VAT from it. That's for gross products. For income type, so gross product is used by Brazil and Argentina. Income type variance, that is income type, it calculates VAT based on the income or profit earned by businesses. So this one is not on the value of goods. They look at your profit and you calculate your VAT percentage on your profit, just like you are doing for CIT. That's for the income VAT now. But they are allowed to deduct certain expenses, such as input VAT, wages, or material, before calculating the VAT on the profits. That's for income. Consumption type. It is based on the value of goods and services consumed by households and businesses. So the VAT base is the value of goods consumed by WS, and then a single VAT rate is applied. Businesses are allowed to deduct input VAT from their output VAT. This is the type that we are using in Nigeria. So this is the type that we're using in Nigeria. So the people that use this is Canada, Australia, and Nigeria. So that's all for the types of input VAT. Tax invoice. I think I already spoke about tax invoice. That's the one you issue to your customer to let them know that they have to pay VAT, right? So it has to include the following information: the TIN of the person, name and address, VAT registration number, supply date, name of the client, gross amount, and the tax charge. So it should be you should issue the tax invoice on this on it should be issued on supply, whether the person has paid or the person has not paid, because it is needed. It's very important for what audit purpose, VAT recovery or VAT compliance. If they come to you and say you don't need to pay VAT, you quickly bring out your invoice and say, this is it, I have paid. This is it, I was charged. Now penalties. The penalty is very, very plenty. Please, you have to read penalty by yourself. I am definitely not reading penalty. So you go and you read it, but please, it's very important. Go and read penalty. Now there's something called the VAT Technical Committee. This one too, I'm not wasting time on it. So we have the committee headed by the chairman of FIRS, directors in the FIRS, legal advisor, a director in the Nigeria Customs Service, and 3 representatives of the state government from the Joint Tax Board. These are the people that form this committee. What are their functions? They want to consider all matters that require professional or technical expertise and make recommendations to FIRS, advise FIRS on administering the tax, attend to any other matter that FIRS would tell them to attend to. Tax enforcement and practice. VAT visits. Now, VAT inspectors from your local office can at any time come to your office and ask you, like, they want to ensure that you have complied with VAT, ensure that you have deducted the amount that you're supposed to deduct and you have accounted for it well. They want to ensure that you are doing enough bookkeeping, right? And they want to educate you on whatever new development that we have on VAT. VAT drive, all these ones, I think I've spoke about it one way or the other. Merit and all this one you can read by yourself. Advantage of VAT. Let's do at least one calculation before we call it a day, please. So now let's do number 1, Jaji trading company. So let's go ahead. Jaji trading company. Let's read the question. Somebody is raising up a hand. Abby's aunt. Elizabeth.
Good evening, ma.
Good evening.
Please, I just have a question regarding VAT. For instance, now a company that operates on a higher like they give out tricycles and motorcycles on higher purchase. So
Yes.
insurance part of it is when a financier, for example, an accident happened, so we needed to repair the bike. So for the insurance claim, our financier needs to send inform their insurance the insurance company in order to get the insurance claim from them. So we can't wait for them to for the long process before we get the money back. So we use our own money now to repair the bike. Then we now issue them a receipt for refund on the repairs of for the insurance claim repairs. We are not the one getting the claim directly from the insurance company. Our financiers are the one getting it. So in that case, am I expected to add VAT on that refund invoice for insurance claim?
I don't think you are supposed to do that because it's not like, how can I say it? I don't think that particular service is vatable, because what you did was to repair the vehicle, right? The vehicle is for your company, then you
Ye-
got into an accident and you repaired it.
Yes, it's just like they are financiers, right? We are still paying. They give us these assets. We give riders for iron. We give them for higher purchase. So we are still paying them on those assets. So some of those assets are operating is which is also some of them are their assets. So for the ones that are their assets now, that we use our own money to repair, and we send them invoice for refund. That's what I'm saying.
So you repaired the the person that repaired it for you. Did the person charge you VAT, or did
Yeah,
you or is it your company that repaired it by yourself?
our company repaired it on their behalf now, because we can't wait for
Now,
them to.
did the mechanic charge you VAT?
No, no. But when we buy spare parts, there are some items that are vatable for spare parts.
Know that that particular asset now, like that particular vehicle is an asset. Such VAT, except if what you do is to buy and sell vehicle, that vehicle is a good to you. Like we said, if that is your inventory, then you add it to the, like, it's going to be like an input VAT samakwe. You add it to their money. You add the VAT to their money. All the VAT that all the spare part that you bought, that they tax you charge on, that they tax you VAT on, you add up the VAT together in you. It serves as like an input VAT, right? And when you also want to like put out that particular vehicle, you charge VAT. Because in your case, if I understand you well now, the vehicle is like an inventory to you guys. You sell the vehicle, it's not an asset to you. You sell it as an inventory. And that means that input VAT is allowed, output VAT is allowed. So yes, if assuming it's not an inventory to you now, it's just like the cost of the asset. I don't know if it's what I'm trying to say.
All right.
Did I like answer your question?
Yes, but I didn't really get if VAT should be added to the refund. That's just what I wanted to know.
The refund, of course, since you guys paid VAT, so they have to pay you back now together with the VAT that you paid.
Okay.
You have paid VAT on the parts that you used to repair the car. Definitely, it has to be part of what they will pay you back on.
Okay, ma. Thank you so much.
You're welcome. Okay. So, Jaji Trading Company is registered for VAT purposes. The accounting record of the company reveals the following information. For the year ended December 31st, 2024, we have the revenue, purchase of raw material, traveling and transport. We have VAT inclusive, VAT exclusive, vehicle running expenses, office equipment, furniture, motor vehicle, audit and accounting, bank charges, miscellaneous expenses. Compute the VAT payable by Jaji Trading Company for the year ended December 31st, 2024. So now let's write it. Already computation of VAT payable or VAT liability. I don't know whether I should liability or what does it mean says VAT payable, okay. Payable for December 31st, 2024. So now remember when we were talking about how to calculate our VAT, what are you supposed to calculate first? Is it input or output VAT? You guys are not responding. Which one did we say we'll calculate first?
Output.
Output, yes. Thank you. I don't know who spoke, Sha, but thank you. Output VAT. Output VAT. So, yeah, all these items that they have listed, which of them constitute an output VAT? Output VAT is VAT on sales, Abi, and the only sales that we have here is the revenue, right? So we have revenue, VAT inclusive. The reason why they wrote VAT inclusive here, let me tell us, you have to be careful when you hear the word VAT inclusive, VAT exclusive. It means that the amount of money that you are seeing in on the screen as should I say VAT have been added to the money. That is, it includes VAT. The money includes what? VAT. Are we together? So now to calculate VAT on such an amount is going to be, VAT is 7.5%. So instead of 7.5 over 100, 7.5 divided by 107.5. Let me open bracket and close bracket so it's going to be easy for us to understand. Then multiplied by, what's the figure? 3,400. Let me come on. 3,400, 500. Please, do we understand it? The reason why we use 7.5 over 107.5 is because it is VAT inclusive. This money already includes VAT. You know that when they charge their customers VAT, the customer will pay the money together with the cost of the good. So they added this, they did not separate it. That's why it's VAT inclusive. So how much do we have? So that was a mistake. I wanted to write capital letter in. So now let's calculate that. 7.5 divided by 107.5 multiplied by 3,400, 500. 2,1. Let me put it here so I can see that I right. So we have 2,1,2,0,965.1162. Let's stop there. So let's put it in the comma. So this is what our output VAT. Because there is no other output, like no sales now. That's the only sales that we have. That's all for output VAT. Now, input VAT. Input VAT. Input VAT, remember, is on what? Purchases. So now the first thing, of course, purchase of raw materials. So we have purchases. And in these purchases, they wrote it there that is what? VAT inclusive, which means we are going to be following the same format. 7.5 over 107.5 multiplied by 20,140, 650. Let me put comma so we'll not get confused. Okay, so what do we have? 7.5 divided by 107.5 multiplied by 20,140, 650. We have 1,405,161.627. Okay. Okay, so that's purchases. Traveling and transport. Is this supposed to form part of our input VAT?
No,
Why?
it's an item of P or L.
God bless you. God bless you. Who said that? Who responded to the question? Who responded?
It's me, Uche.
Oh, Uche, let me clap for you. I don't have money. If I have money, I would have given you. But I will clap for you. Let me clap for you. Okay, so that's correct, actually. Very correct. It's an item of POL. So how about vehicle running expenses?
It's not.
The same reason, item of P&L. How about office equipment?
It's capital in nature.
Capital. So you are adding it to the what? Cost of the assets. Same thing for furniture and kitchen and motor vehicle. Audit and accountancy fee.
No. Yeah.
No.
It's an expense.
Expense. So audit, bank charges, miscellaneous, all of these things, none of them fall under what input VAT, which means that this is the only input VAT that we have. Let's put minus equals to minus this. So this is our what? VAT payable. Why is it payable and not a VAT refund? Guys, why is it payable and not a VAT refund?
Because what you receive.
Eh?
Because
yeah.
what you receive is more than what you're supposed to pay or what you paid also.
You're correct. Yes, I understand what you're trying to say. Our output is more than our input, which means that the VAT that we have received on our sales is more than the VAT that we have paid on our what? Purchases. Yes, that's correct. So let's treat one more example. This is not similar to what we have done before. Number 2, let me make number 2 assignment. Guys, the people will not do it, but I'll try to give you assignment number 2. It's quite similar to what we just did. So try it. This number 3, I want us to do it in class because it's shock. I tell you, the number 2 is shock. You can't do it now, it will take time. Maybe in next class we'll start with number 3. But if you guys want to try it at home, you can try it. If any, don't go and check past question. If you check past question, my head will catch you. But if anybody gets it, I promise the person something. I promise the person. But fear God, though. Don't go and look for the question and go and check answer. Okay. So number 3 is not something we can do now. It's really, it will take time. Let us try number 4. I think number 4, number 5. This number 5 too is simple. Let me see number 4. Let's do number 4. Number 4 has opening and closing inventory. So let's try something that has inventory. The following information relates to Havila Manufacturing Limited. We have them. Additional information. The company purchased plants and machinery that cost 24,750,000. This amount was included in opening inventory, VAT inclusive. VAT and withholding tax remitted during the year amounted to this, respectively. Inquired, compose the net VAT payable by Avila Manufacturing Limited for the year. Okay. Avila. Let's leave one more space. Avila Manufacturing Limited. Computation of VAT payable. Okay. And the first thing is what? Output VAT. So for output VAT, what do we check? Cost of sales delay. Sales is what our output VAT is on. Sales. Did they say whether the sales is VAT inclusive or exclusive? It did not tell us anything. So let us assume that it is VAT exclusive. Abi? I don't know whether I should say exclusive or inclusive. Let's assume it is inclusive, please. I'm a bit confused whether I should make it inclusive or exclusive. Since we have done inclusive before, let's make it exclusive so we can see the two sides. Do you get? So for this one, it's going to be 7.5 over 100. Let's put a bracket. Multiplied by, how much is the sales? 206,250,000. So let's put that here. Repeat control again. So how much is this?
154,688.
Okay. So then we have input VAT. But in this case, we have opening and closing inventory. Abi?
Yeah.
So because we have opening and closing, we have to adjust the purchases before we can should I say, charge VAT on it. Remember when we already talked about the written aspect. This is just like the calculation to show us the practical way of doing what we read. Yes.
Yeah.
So the first thing is to do what? Your opening inventory, add your purchases. So we have opening inventory. How much is it? 24
915.
9. We don't include comma, so 2. I cost 1 square. 915,000. Remember that there's a level of precision up. There's a level of precision. So okay, that's opening inventory. You add purchases. How much is the purchases? 94,600. So how much is this all together? Then what do you do? Less closing inventory. And that will be minus 4865. Okay. So
Sorry, ma'am, please, you have to correct that sales because I approximated it. I didn't know you used the 3 zeros.
okay. So there has to be 000, Abby.
No, 15,468,750.
Is there a point there?
15 million
Okay, there's 750 there.
Yes. 46, yeah, all right.
It's supposed to be up to this. I don't think it's supposed to be up to this.
Since I used the 206,250,000.
Let's do it again. 7.5 over 100 multiplied by 206, 250.
I thought you said 250,000 because we use the complete figure on inventory. That's why I used the whole.
Yes. You are still correct, boys. It's the last zero is not supposed to be there. So
Okay.
this is correct figure. Do you get it?
Yeah.
Yeah. I felt like the figure was too much. That's how I knew. So where were we? Where are we then? We have talked about my purchases, freight charges. Freight charges now. Are we supposed to deduct freight charges
Yes.
from our purchases? Why do you think so?
It's not from the purchases, but it's part of what they cost to bring the material to the. I don't know how to explain it, but I think it's supposed to be an input VAT. I don't know.
Don't touch it, you. So are we supposed to deduct it, or we are supposed to add it?
That's input VAT. I'm supposed to deduct it. It's an input VAT. What you pay to
No,
get,
like freight charges. I'm talking about freight charges.
you deduct it.
Are you sure?
It's a standalone, right? You just deduct it.
We are adding.
Okay.
You are supposed to add it. So how do I explain that? It constitutes part of purchases. It constitutes part of purchases, and should I say I don't know how to really give a valid explanation on it, but it's like what you said now. It constitutes cost of purchase, like under IS2. Do you get? So if you go and check the IS2, I think it's even written there as freight charges. All those things that constitute the what's it called? Cost of purchase. So freight charges is there. And the reason why we are adding is because this is an expenses, like assuming it reduces our purchase cost now, but it did not reduce, oh, it's increased. It's not an income, it's additional expenses.
Yeah.
So other direct materials, do you think we are supposed to include that?
Yes.
Why?
It's what we paid now is purchase. I don't know. We paid to buy the material now. Input is what we paid, right? It's supposed to be. It's another item we bought. We bought also.
Does it constitute part of the how can I say it? Does it constitute part of this
Input.
purchases? Yes. Do you think it constitutes part of our purchase cost?
Yes.
Why?
It's a material. It's a material. Now. It's part of the material that we paid for also. I don't know.
Well, you have a point, because it's part of what we paid to, like they said, the company is a manufacturing company. So I believe it ought to be there too. It constitutes part of what we used to produce what we sold, right?
Yeah.
Mhm. So in the answer to the question, we did not put it there. But personally, I also think it ought to be there. It form part of direct cost.
I
So
think
that
I think you
you
made
said,
mistake somewhere. I
okay,
think
maybe
you skipped
the people,
something.
I cannot answer for them. I don't know why they skipped what they skipped.
No, they said that there was the company purchased plant and machinery for 24,750. The amount was included in opening inventory. I think you're done with opening inventory. You did not recognize, you did not
Okay,
list that money from
we
opening.
can still make an adjustment for that.
Okay.
So what we'll now do is the what? Plant and machinery, plant purchased. Sorry, oh. How much is plant purchased, please?
24,750.
So we'll remove it.
Okay.
Why? Because we are supposed to remove it from what? I have to learn. So it's either you remove it from this one straight, it will give you the same answer.
Okay.
Minus. So okay. So this is the amount that we're going to calculate our what's it called? Input VAT on. So input VAT. Ba- ba- So input VAT is going to be. Did we remove our closing inventory? We did not remove our closing inventory. Um,
So that has been removed now.
oh, sorry. I did not know. I thought we did not remove it. Okay. Okay. So I'm trying to see something. The opening inventory and closing inventory was VAT inclusive. Did you get, like, opening and closing inventory are VAT inclusive? So I'm going to be treating every other item as VAT inclusive too, because it is the cost of this purchase that we are going to, like, categorize as inventory, Abi. So it's going to be 7.5 over 107.5. I don't remember to put brackets. Multiplied by 88 into 3. So what do we have here? This one will make it minus because we're going to be removing it. Please, do you guys get the reason why I made it VAT inclusive? Six million 139 6,139 535. Okay. So okay. Then we can now calculate whether we have. Why is answer that? Remember. So this one is going to be what? VAT payable. So any question? I'm coming, please. Do we have any question? Are we good? Guys, I'm back. Oh, I guess this is where we say goodbye. And in the next class, we are going to be like solving question 2 or question 3, sorry. After question 3, I might have to say goodbye to VAT. Then we'll continue personal income tax, right? We start personal income tax. So since you guys have no question, this is where we'll say goodbye. I'll be uploading VAT and the Excel sheet on the Google Drive so you can have access to it at any time. So I guess this is bye-bye for today. Maybe still saying bye-bye.